All right. So last week, obviously a little late, so I'm trying to catch up. This week will be on time. We're going to talk more about taxes because also I noticed that the video for this week that you comment on is deals with tax brackets, and a lot of people don't understand tax brackets, and you can really, I mean, it's pretty widespread. You'll hear people make comments talking about, oh, I don't want to do that because I'm going to get pushed into the next tax bracket, thinking that they're going to impress you with their knowledge, and that really shows that they absolutely do not understand the concept. So it's not that tricky, but it's non-intuitive. We'll go through it and show you. So what are taxes about? Obviously they're the way the government gets funded, right? You're paying taxes on everything, and I know I sound like some get off my lawn old crotchety guy, but I'm telling you, you pay so much in the way of taxes on so many different items. If you add it all up, it's pretty overwhelming. You pay it on earned income, so that's what your check is. Consumer purchases, that can be in sales tax, other things, also user fees and stuff like that. Obviously, sales tax up here is not much, but if you're buying things, from other states or other places, or corporations that have already been taxed, it all gets passed on to you. Wealth transfers and capital assets, and you know, when we talk about like capital gains, for example, capital gains, whatever. It's not confusing, but it's a word that you may not be or a term you may not be familiar with. But what it means is you buy something for one price and you sell it hopefully for a higher price, and that difference is a capital gain. And so it's not earned income, but it is taxed. You do have to report whether theoretically if you sell a vehicle for a higher price, or if you sold something like stocks or mutual funds, something like that, though, it definitely will be taxed because it's tracked. You get a form round about now, late January, early February, listing all those items. So that's a tax. And then what they call sin taxes. So, alcohol, cigarettes, gasoline, and other stuff. Dog dog licenses and stuff like that if you actually pay for them. And the rest of those items are taxes that are, yeah, more like user fees, or sometimes they're just straight taxes that are assessed on, things that they're trying to, change your behavior with. So there's a lot of taxes that are, that where the politicians or whoever, and politicians you elected are, trying to modify your behavior for, the betterment of society. So corporations pay taxes on profits, certainly. Homeowners pay property taxes, especially, that's locality related. Large chunk of that goes to schools. Taxes used to pay for government services and programs, and federal, state, not so much here. And then um, at the local level, that's often derived through property taxes, the way the local level typically gets their tax. But there's weird things. I actually own an airplane, and I got a letter from the municipality of Anchorage telling me I owed them some money for because I had an airplane. I'm like, well, my airplane's not even here. I haven't flown in here. Yeah, you still owe us some money. It's like, what? Anyway, it's kind of crazy the way some of those things work. IRS, they don't like to be called the IRS. I mean, it's just silly. If you write the check to the IRS, they they want it written out to Internal Revenue Service. Like, anyway, taxes paid in several ways. Obviously, at the time of the transaction, through withholding, or by making estimated quarterly payments. So, if any of you have, for example, ever been lucky enough to, win $1 million in a casino or something, they're not giving you $1 million. They might give you a check, but that check is going to be for somewhat less. It's going to be, 700,000 or something, because the IRS is going to make sure that there's a withholding on that amount. And again, you'll get a 1099 G in this case, G is in gambling, for those profits. So any of those big winners. It's just interesting. There's a whole bunch of 1099s are a common form to use to track transactions like that. But um, some of these things you may not be very familiar with them, but as you get along in your financial life, you'll get more and more mail this time of year, that either you know work out and put into your taxes, or you pass on to the person who's doing your taxes. So this is what I was talking about last week. Um, the date for any changes ends with a calendar year, and then it needs to be filed on or about April 15th. Now, typically, if it works out on a weekend or something like that, the actual date is different. But people will take it up all the way to the end. I don't generally wait till that day, but I generally don't turn it in early either, because again, there's requirements for people who are supposed to give you documents. Like say if you own a house, you'll get a 1098, which shows how much interest you paid, and those are the numbers that you want to use on your tax form, because guess what? The IRS also gets a copy of that 1098. So those numbers better match, or they'll come looking for you. The IRS is pretty powerful in terms of the enforcement and the laws. And part of that has to do with, yeah, they don't want people cheating on their taxes, but also it's a really effective means for controlling criminals. And this goes back to organized crime type things. It's very hard to catch some drug dealer in the middle of the transaction. It's dangerous and the rest of that. It's far easier just to go up to you know some person who is a drug dealer, and they've got a stack of $1 million sitting there in front of $1 million in cash, and all the IRS has to do is say, where did you get this money? you know and if you can't show the tax documents to prove that that was claimed, and they got their bit on the taxes, that it was some sort of legal income, you go to jail, and you go to jail for tax evasion. The true crime might have been a drug dealer charge, but that's a hassle. It's far easier just to wait till the cash is there, and then um, if you've got cash that you can't show the receipts for, again, it gets a little more complex than this, but that's why a lot of the IRS codes are pretty strict and pretty well enforced, because they're an indirect means of controlling that sort of crime. And that's also why there's sort of press, especially in Europe, to go with cashless transactions, because cash is kind of, they'd much rather have an electronic trail of where money is being transferred from one place to the other. Um, and believe me, people do keep track of it. I have security clearance due to the work I do, and I have to do a reinvestigation every 5 years. Anyway, last time they came to me and they said, "Hey, you transferred, $13,000 on such and such a day. What was that all about?" And anyway, the bank, because that number was over their predefined limit, it was reportable to the IRS, and that made it into the federal. Anyway, it went into my so-called permanent record, and anyway, they were looking for an explanation. There was an explanation. It wasn't a big deal. I just bought a piece of equipment, but and the banks are kind of funny too. They won't actually tell you what that limit is, but it's probably somewhere above $5,000 if you walk in there consistently with cash transactions above that amount. They will probably, well, they're obligated to report it. So anyway, um, Social Security, Medicare taxes, yeah, those are part of it. Now, those are actually more attributable, although Social Security, unfortunately, there's not this concept of this lockbox with your name on it, with your money being held for you. Yeah, that doesn't really happen, and which reemphasizes why you saving for your retirement is critically important, because Social Security is being funded by or is funding all sorts of things that you wouldn't typically think are necessary. We'll talk more about that, but I'm already getting off on a tangent already. Medicare taxes. So again, paying for health services. You've got Medicaid, Medicare. Medicare is the for the elderly. Medicaid is more of a welfare related program. But anyway, some of these other deductions that come out. The primary tax. I mean, these are still taxes, but the taxes we're going to be talking about are on your standard income taxes. Your employer matches amount. Yeah, so that's how the Social Security amount is derived. And the thing is, too, a lot of people will have maybe a couple jobs, and if you hit this amount, 118,000 between the two of them, and these numbers are getting dated since that's 2015, you actually don't have to pay any more into Social Security. So, I've at one point got a refund um, because I'd hit that cap because I was working two different gigs that paid a bit. Um, Self-employed people, yes, have to hold back that. Um, but again, we'll get into that. If you're self-employed, it gets a little bit more cumbersome, and I've never had that as a primary source of income. I've always had a primary job and then a sort of a side hustle, self-employed thing. So personal income taxes. So taxes imposed on income earned. You've got all these different forms, 1040A, 1040EZ. You're going to want to gravitate towards the 1040. It's obviously it's more complex, but there's more deductions. And if you're doing something, if you have a small business, if you're deducting property, if you're deducting any of those, these simpler forms don't have those blanks. They don't have that capacity for that. But if you're just, you know, working a part-time job, you can probably go through with the 1040 easy. And then a lot of these tax filing services too will even, let you file for free and there will be no charges involved. That's because, they're trying to develop brand loyalty because at some point in your life, let's hope you're going to gravitate towards the more complex ones. So anyway, April 15 or thereabouts each year. This is just something, other stuff not quite in the book that I put in here just to kind of show you what happens, where the federal government gets its money. So income taxes is, that big a chunk, about 50%. Sorry, the resolution's garbage. Corporate tax, payroll tax, so that other stuff, excise taxes, and others taxes. So about 50% is coming out of income taxes. This is the other thing too. So there's different tax systems you could have. You can have a regressive tax or a progressive tax. So a regressive tax would be perhaps like a user fee, where if they say your car registration is going to be, you know, $200 a year regardless of income. Well, for a millionaire, $200 is no big deal. It's not going to be such a big hit on that person. But for somebody who's just scraping by, $200 is going to be, more significant. So that would be an example of a regressive tax. A progressive tax would be based upon your income, where somebody who's not making much money would not get taxed at a very high rate, and somebody who's killing it would get killed. They would get taxed at a high rate, and so you can see our tax system is a progressive tax system where the top 20% of the income earners are paying 88% of the tax. And these guys down in the bottom 20, the bottom 20% of the income earners, they're at -4, meaning that they're getting more back than what they're paying. And again, this is continued on. I can update this chart, but this was best illustrated. The numbers haven't changed too much, but yeah, when they talk about soaking the rich or we're going to tax the wealthy, and it doesn't work because those people are already paying quite a bit, And when they try and do it in Europe, Macron pulled this, millionaires tax. Well, guess what? Millionaires have the money to travel or have the money to hire lawyers or have the money to avoid taxes. And so it sounds popular, it'll get people elected, but does it ever actually get paid? No, not really. And then even so, you're if there's not that many of those ultra rich folks around, so they tends not to work. But anyway, enough of that. These were some of the changes that came along a couple years ago when you heard about the tax cuts that were implemented. So the standard deduction went way up. 12.7 up to 24,000 for married couples. So that was a standard deduction. This gets to be, I haven't really explained deductions yet, but basically what they'll say is you can add up all your little deductions. Like, we've talked about, or I've mentioned a few things that are tax deductible, like mortgage interest, like, other, oh, things you had to do for employee expenses for your employment that aren't reimbursed, and home office expenses and all these other little deductions that you're going to try and claim. And what the government says is that, you can do that, but if you want to, if they don't total up to at least 24,000, then why bother? Because we'll give you a $24,000 deduction. So the way this works in TurboTax or something like that is you add up all your deductions, and if they don't hit 24,000, then the program says, yeah, it makes more sense for you just to take the standard deduction. The standard deduction is this deduction where that's given to everybody regardless. So um, anyway, you compare those two numbers. If your itemized deductions exceed the standard deduction, then obviously you're going to itemize. If the standard deductions don't exceed that amount, then you don't. So anyway, it's people, you can get in obviously an entire career or a degree in just tax law, and we're not going to approach that, but I'm just giving you kind of an overview, enough to um, understand the system. Child tax credit, again, having kids is good for society, and so hey, $2,000 per child in terms of a tax credit. This will come up again. We'll talk about credits and deductions. When somebody says, hey, you want to do this because it's tax deductible, that's good. That can be deducted from your taxes, but it's deducted from the income, right? So if you're making $100,000 and you have a $2,000 tax deduction, you will then be paying taxes on $98,000, which is nice. But way better than that is a tax credit. You get a $2,000 tax credit. Now you're taking, let's say out of that $100,000, let's say you're going to have to pay the government 15,000 in taxes. Well, with the tax credit, you'd pay 13,000. So it comes right off the taxes. So it's far better, far better. Anyway, we'll talk more about that. I know credits and deductions are confusing, but they're not the same. Um, Personal dependence. Some of these things are get down to the weeds. This is a payback to the blue states. Some states, California, New York, whatever states that have high um, local, state taxes, and they've always been deductible against your federal return. So there was no incentive for those states to necessarily lower their income taxes because their residents just wrote it off against their federal amount. So you live in California and you're paying 20,000 in state taxes. Well, you could subtract that 20,000 from the amount due to the federal. Now that number is limited to $10,000, which effectively increased the taxes of everybody in those types of states and those, Connecticut and all those places with high state income taxes. Healthcare, we'll talk more about that, but it's from a tax perspective, it's a little bit more involved. and then a lot more about it. Anyway, this was just sort of a summation of those things. Um, Filing status. This is an elective thing to a certain extent. Well, elective if you want to, if you're married, you have the option of filing jointly or you can file separately. Single, you're either single or you're not. The exception was single being if you have a dependent, then you can claim head of household, which is very cool because now you pay the rate, similar to somebody who's married, so it gets your rate back. If you're just a single person with no dependents, you are going to be paying a high rate. And anyway, we'll show you what those rates are here shortly. Qualified widow. Um, the deal with that is, let's say there's obviously a death there. It would be pretty uncool to just slap that person with the full tax rate as a single person. So they will tax you as you know as if you were still married. So these forms, you don't really see them. Not you won't see them up front and say something like TurboTax or one of those. It's only when you print them out. I mean, you have the option of getting these forms and filling them all out and printing them in, but it's a fair amount of work. And the reason why some of these tax programs are advantageous is because obviously your name and all these other things are not going to change year to year, and all this filling out and erasing, and it's just far easier to do it on a computer and spend your time and your brain bites working on the amount of tax that's owed, and then also to run different iterations. Try to file both um, married filing jointly or married filing individually, and see what works out best with the numbers. There can be some real changes in that, especially if one person is making quite a bit of money. If you're married and the other is not. You just have to look at the numbers and whatever, with the objective of paying the solution that gives you the lowest tax owed. So let me just step back one more page too. So anyway, you're going to put in all your numbers and alimony, business income, capital gains, IRA distributions if you took money out of those retirement accounts, farm income, unemployment. Some are going to apply, some are not. And then you're going to come up to a adjusted gross income. And adjusted gross income is going to have, it's going to be less because it's going to um, have certain numbers reduced out. But again, it's a little more complex than it appears. For example, I had a daughter. She went out of state to school. I thought, oh, this is going to be, it's going to be painful, expensive, but at least all those expenses will be tax deductible. Nope. Based on income, you needed to be below whatever income for any of that to be tax deductible. So I wasn't making that much money, but just the same, none of that was tax deductible. So there's the tax code is very complex, and that's why it helps to run trial runs to um, make sure you understand what you're going to qualify for and what you don't before it's done. Um, so anyway, these numbers will be filled in. Child credit type things if you're paying for child care. Again, there's certain caveats on that. Education credits, the child tax credit was in there. You're going to subtract those lines off. Other taxes, sometimes, first time home buyer maybe, health care, other things. And then the payments. Have you made any prepayments? State and local taxes. And then if you have a positive number or a negative number, um, you'll get a refund if you've overpaid, and if you haven't, then you owe them some money. So anyway, you don't typically see the 1040, like this, but you do have the option of jumping it in, filling it out with a pen or well, I guess a pen, yeah, but just not done very often anymore. So here we're going to explain some of those categories a little bit more. Gross income. So this is everything, right? Salaries, investments, interest, dividend income, capital gains. So you sold stock, you sold a house, you sold whatever. Now another again, the stock market's probably got a pretty powerful lobby, but it's nothing like the mortgage lobby. And if let's say you sell a house for whatever, 500,000, you paid 300,000, you obviously owe tax on that $200,000 gain. But if you've lived in a 3 out of the past 5 years, it's tax free. So again, there's some good deals in the tax code concerned with real estate. If you did the same thing, if you made 200,000 on stocks, you are paying that amount of money. You're getting that entire amount. You're going to have to pay tax on it, and this again gets into that short-term and long-term capital gains. If you had it for more than a year, then you'd be paying 15% on it because it'd be long-term capital gains. If you had it uh, less than a year, then it'd go into your regular income and you'd have to pay um, perhaps up at 28% or 33%, whatever your tax bracket is. So it makes a huge difference. So wages and salaries, interest income, yep, it's more delineated. Dividend income, mutual funds, stocks, it's all treated the same. It's all income. And this is what I was just trying to explain. And then we go back through it. So 12 months is the cutoff. So again, this short term means that it's going to just be like regular income and be taxed at a fairly high rate. Long term capital gains is going to be taxed at 15%. So, and that's actually, some people may squawk and say, well, that's not fair. The whole Warren Buffett thing where why is, that guy only taxed 15% on his investments when, I'm taxed 28% on my income. Well, the fact is that let's say you are going to invest some money in the stock market or whatever, and then you make a profit off that investment. You already paid. I mean, where did you get that money initially to invest, right? You paid tax on that earned income, and then you invested it again. So you've essentially already paid tax on this amount of money once, and the new money that you've acquired by investing it, um, you know, it should not be taxed as earned income. But that's the rationale there. Um, this is what they're saying. So this 0 to 20%, that's one of the modifications. It's 15% under the Trump tax law. Gross income, dividend, get a little redundant there. Comes out on the Schedule B. So there's going to be all these schedules. We have the 1040 and then we have all these schedules. So B is interest and dividends. Foreign accounts as well. Schedule D, capital gains and losses. So these numbers, again, if you're using, I again sound like I'm shilling for TurboTax, but you type in your brokerage name and your account information, and they can actually transfer all these amounts electronically and fill out these forms for you. And like I say, one copy, the investment company will send one copy to you and one to the IRS. So these numbers, it's in your best interest that everything matches up. Determine gross income. We did that. Contributions to individual retirement accounts. Again, these are income limited. If you're making, say, over 100 grand, you may be excluded from being able to deduct to an individual retirement account. But if you're not, let's say you put $2,000 in your individual retirement account, you can it will reduce that from your taxable income. Sometimes interest paid on student loans and other special circumstances. Standard deduction. This is what I was discussing before. So again, the way they're determined at a fixed amount that can be deducted from your adjusted gross income. Not affected by income, not affected by filing, or affected by filing status and age. And then the IRS changes these numbers all the time. But this is just a number. It doesn't really correlate to anything. But it's a certain threshold, and when you're itemizing your deductions, if your itemized deductions say only come up to $10,000 and the standard deduction is 24,000, well, obviously you're going to take the standard deduction, and it's going to simplify your process, and you're going to be able to use a 1040 easy or whatever. If you're going to itemize, you need to itemize. So as I showed you, those numbers have increased greatly based upon the Trump tax thing, which is a positive. So itemized deductions, specific deductions. So this gets to be, kind of a scavenger hunt, and the internet, the software that's provided on these tax programs is very helpful in making you, kind of methodically go through a checklist and look for items that were deductible. So interest on mortgage, on home mortgages, state income tax. So local taxes may also be tax deductible. But again, this is the big, sticking point where they said, yeah, you can do that, but only up till 10,000 anymore. And many of these high tax states, that hit them very hard. A lot of movement out of some of those high tax states because people's taxes, although just about everybody's taxes went down with the new tax cuts, people from those states actually went up. Real estate taxes are deductible. Medical expenses, but only in excess of 10%. Fortunately, I've never been that unhealthy. I mean, if you are making 100 grand and you'd have to have $10,000 worth of medical expenses that were not insured, not you were not reimbursed for, just 10,000 bucks out of pocket, which obviously can happen, but let's hope not. So there's a limit on that one. But charitable gifts, cash, property, all that's all one for one. That's good stuff. Now, I'll talk more about the tax. Well, I guess I got to talk about it right now. Okay, so gets back to what I was talking about with the tax credit and tax deductible. If somebody says, I'm going to give you $1,000, some government program, you're going to get $1,000 tax credit. That means you subtract $1,000 from the amount of tax owed. That's huge, right? But if, let's say, you donate $1,000 worth of stuff, whatever it is, to a charity and it's tax deductible, you don't get $1,000 off your taxes. You get $1,000 deducted from your income. And so let's say you're in a 28% tax bracket. What just happened when you gave that $1,000 to that organization and you reduced your income by $1,000, because you're in a 28% tax bracket, you saved $280, right? You're in a 28% tax bracket, meaning if you make $1,000, you would pay 28% of that, $280 in an additional tax because of that income. Because you had that tax deduction, you didn't have to pay that extra 280, so therefore, that's a savings. So it's a good deal, but it's not a one for one. And if you're scraping by, if you're in that group that gets 4% back, the advantages of tax deductibility are nil. You're not a tax payer. You're somebody who's getting taxes. So anyway, if you're a high wealth individual, like let's say you're somebody, a Californian who's paying federal and state income tax, and you're paying quite a bit. I mean, some of those folks pay 63% tax, combined state and federal take. You would definitely be interested in taking that. So anyway, records, receipts, we'll talk more about that. And they clamp down on us. They know how things work. It used to be not a scam, but there used to be a lot of car donations because it's a hassle to sell a car, and why not give it away, and why not say it was worth $3,000 when in reality you really would have had to find the right buyer to get $3,000 out of the car. What the IRS did was they changed the rules a few years back, and they said, nope, we're going to track this thing all the way through to when this car is actually disposed. So you can donate your car still, but it has to go all the way through the process, and then the organization that you turned it over to, they have to show, what value was actually derived from it. And a lot of times those things just go into the wrecker, go to the smasher. So you're getting 50 or $100 because that car was really not worth much. So things change. Other expenses, thefts, losses, jobs expenses. If the jobs expenses, if substantial, they're quite a few. I mean, if let's say you've got a career where I for years when I was in the military, I deducted haircuts, I deducted certain things I had to have, publications, that were professional and not reimbursed. I've had vehicles that were a total loss. That's if you have things stolen. There's just a whole lot of expenses. If you're, especially for some of you, when you're trying to get a job and you've got to go someplace for an interview and you're doing it on your own dime, you're not reimbursed by that, potential employer. Job search expenses are deductible. Lots of things are deductible. So the list is long and you need to go through and review it. But it takes some time because you want to make sure, what you're doing is legal. There's certain things that are not deductible. Um, Obviously, anything that you're reimbursed for, you can't deduct medical expenses that insurance paid for or something like that. But anyway, it's a lot of doing taxes ends up being sort of a deduction hunt. And again, I've talked before about farming being great for me because there's a lot of things I would like to have: tools, tractors, welders, all kinds of stuff that I would like to have for hobby use that are completely deductible because they're primarily used under the farm. So anyway, Schedule A, itemized deductions. All kinds of items. It just, my point is that it'd be very difficult to do just looking at these forms without quite a bit of research. Back in the day, before they had some of the software, there were these basically paperback books, Barron's Tax Guide or something. It was about 2.5 pages wide, and you would go through there and it had a section on all of these deductions. But some are pretty straightforward. The mortgage and interest that comes through on the 1098. A lot of times these have forms associated with them. That money you spent buying your TurboTax or doing your research, any money there, that's tax deductible. There's just a whole myriad of things that are tax deductible. So they're proponents of TurboTax as well. But anyway, there's good software out there from a number of companies. Exemptions. So this has to do with, spouse, dependents, it's going to affect your tax amount that's going to be owed. Taxable income. So you got the AGI, adjusted gross income, less deductions and exemptions, and then you go in there and you pay your taxes. So remember what I talked about progressive tax versus a regressive tax? We don't have a regressive tax system, so they're going to highlight the tax part of it. But again, I would argue some of the sin taxes like cigarettes and things like that, especially when it seems people of perhaps lower income tend to smoke more. Anyway, they pay a pretty hefty load of tax. But anyway, progressive tax system, a tax system where a positive relationship exists between an individual's income level and tax rate, meaning the more you make, the higher the rate. Not only just the higher the amount, but it's a higher percentage. And here are the 2019 tax brackets. I also have the 2020. But the guy on the tape, and there's a video out there that, I think they do a pretty good job of explaining it. But this is the concept of tax brackets. And this is what I was talking about that people don't really understand, but you will. Okay. So different categories across the top. Single, you know what that is. Head of household, that's a single person with dependents. You want to be in this category if you can possibly do it, adopt a child, do whatever you want, but make sure you're, if you can possibly get in that head of household, you want to be there. Married filing jointly, married filing separately. You got to do the math, kind of run it both ways and see what works better for you. And then the widow is thrown in there to throw them a bone, not put them in the single category right off. So here's the tax rate, 10%. So everybody's got some skin in the game. If you're making from nothing to $9,700, your tax would be 10%. Now, again, there's other things that go into this in terms of the actual number. So you saw that the lowest tax brackets actually end up getting money back. But in terms of calculating their initial tax hit, it is going to be based upon this. So $0 to $9,700, 10% of that. So let's say you're making $9,700, 970 would be your taxes due. Okay. Now what happens on the next dollar above that? Everything from 9701 all the way up to 39,475 is taxed at 12%. So this is the fallacy. When somebody goes, "Oh, I don't want to make any more money because it'll put me in the next tax bracket." Well, it'll put that next dollar in the next tax bracket. It doesn't regress and say, "Oh, okay, let's say you make 9701 exactly. The only portion of your income that's going to be taxed at 12% is that $1, right? So, the way this works in reality is let's say somebody's making a reasonable amount of money. Let's say they're making 100 grand. What's going to happen to that person is the first $9,700 out of that 100 grand is going to be taxed at 10%. The next chunk of income from 9,700 up to 39,475 is going to be taxed at 12%. From 39 up to 84,200, that's going to be taxed at 22%. And since they're making 100 grand, from 84,201 up to 100 is going to be taxed at that higher amount. So anyway, and this is not absolute income. This isn't gross income. This is AGI, adjusted gross income. So, which is going to be typically lower. Like, let's say you're somebody who's doing things smartly and you're putting, say, 20 grand into an individual or a 401k. You're putting money in a 401k, which means that is, when you look at your W-2, your income statement there, you're going to appear as somebody who only makes 80,000. So if you're doing well on your um, 401k, your highest tax rate is only going to be 22%. So anyway, and you can see how why you don't want to be in the single category if you don't have to be, because if you were head of household in this case, um, you would be taxed at 10% all the way up to 1385, 850, and your 12% that would take you all the way up to 52, 850, and you anyway it just works out better to do that. And again, it's trying to spread the tax load. Changes between 2019. So 2019, these are the numbers we're going to be paying this year, right? These are not going to be paid till 2021. So the numbers will change slightly, but not that much, 13,850 up to 14,100. So anyway, index for inflation typically. Although there's going to be an election, right? Now the election's not going to occur, so this until late in the game. So this is going to probably be what it is. And if it's, depending on who's elected, it'll say exactly the same. Or if it's, well, it'll probably change drastically, but not till the year after. Determine your tax liability. So tax on base. Anyway, you figure out how much you owe. You don't have to go into tables. I mean, it used to be that's how they used to do it. You go into your tables and you look and you see how much you actually pay. But um, they had those brackets programmed in there. Now, the software prints it out for you. Tax credit, as we mentioned, that's up to $2,000 now. College expenses, savings accounts. I talked about 529s, right? All parents, regardless of income, which is nice. But again, different methods. There's all sorts of special categories. There's many of these programs now too for medical savings accounts and other accounts that are useful. Earned income tax credit, reduced tax liability for low income taxpayers. So that's how you get into those negative numbers where they're getting money back rather than paying. Child care. Child care typically has to be so that that person is out seeking work. It becomes a work related expense. If you're a stay at home, anyway, I'm speaking about things that I'm not that clear on because it's been a few years. But the way it used to work was it was if you had to hire child care to take care of your child so you could seek employment, that was deductible. Adoptions, that's pretty straightforward and a good thing. Financial planning online, again, back to TurboTax. And the thing about it is, they don't need to make a dime off of you. You can go through there and run your taxes and take a look and see how it looks for you. Homework. So, let me see. It's probably logged me out by now, but I had TurboTax up and running a second ago. Again, this isn't my personal account. This is just one I use for illustration purposes. I typed in a few numbers in here. What I said was somebody, they want to go through all these questions. No, I was not affected. So I really don't want to have this. Does get annoying. Cryptocurrency. They're afraid. I did sell some Bitcoin a few years ago, and yeah, they wanted their money. Mortgage interest, if I had to pay any of that, real estate. Let's go back to income. I put in just a sample W-2, right? I didn't fill in all the specific numbers because I didn't have them, and obviously it's none of their business. I just would have made it up. But I put in that I was making 100 grand and that 15,000 was withheld, and automatically it calculated that I owe 253 bucks. So I was actually pretty close. 15 grand. And if you got all those brackets, 10% for the lower amount and then 12%, anyway, it sort of works out. But these numbers are going to change fluidly as we go through and look at some examples, which we'll do right now. So deductions and credits, right? You can go through and say, okay, let's say we're going to give some money to charity. Um, Good cause 5013C, just a made up thing I put in there. It does not matter whether it's money, stock, whatever. That's the dollar value of it, right? They've got things to help you gauge the value of them. They have services that they'd like maybe to sell you or whatever, but yeah, I'll take care of it myself, thank you. Data donation, I just got to make sure it's within, um, the last year. Well, 2000, it needs to be within 2019, right? And household items, sure. And, whatever. But let's say it was 5,000 bucks worth of S's. Method used. They do show you appraisals, average cost, but many times comparative sales, consignment shop value. The important part is if you were called on the carpet by the IRS and you claimed, $5,000 worth of stuff, um, make sure you have some sort of backup. This is why when you give something a goodwill, you typically ask for a receipt, and they usually give you just a blank and you put the numbers in there, but it's just helpful to have. So watch this number right here. When I push this button right here, oh, nothing happened. Oh, purchase price. Yeah, well, it's probably what, 15,000 bucks, 1,500, 15,000. I gave $5,000. That's a lot. Anyway, oh one. So you can see I can waste a lot of time, a lot of your time, my time, messing with this, but I just want the numbers to change just to show you how this worked. They're not going to change it until I fill in all the rest of the data. But the number is going to go down at a certain point, and not right now. Okay, not a great example. Let's see if the mortgage interest part works. Let's look at property taxes. I'm not going to run through too many of the examples if the numbers don't change because I think it's waiting until we get to the end or I fill in a bit more data. Pay property tax. If you're paying property tax, it can actually be, a fair amount. Probably not 12,000, but let's say on an average size home, it's going to be based on the value of the home, maybe 4,000 bucks. Okay, this is working out magnificently. I think I'm going to have to go through and do all this because it's not changing the amount dynamically like I wanted it to. But it's kind of a good overview of taxes. What I would want to show you, though, is, I'll just talk you through it. On a mortgage interest form, when you get this 1098 in the mail, that 1098 is going to show how much you paid in taxes. And a lot of times you can just download it from the company. So, it's probably going to be Wells Fargo. And then some co-loans that, nope, none of these apply. And then you're going to type in the mortgage interest that was paid. And it depends. The way loans are done, you pay a lot more interest at first. When you're paying a loan, let's say your loan is $1,100, your interest and principal are going to change over the life of the loan. And at first, you're paying almost all interest and very little principal. So the dollar figure of your loan is not going down much. You're not building much in the way of equity. You're mainly paying interest. And that's good in terms of tax deductibility. So let's say your interest is 12,000 bucks. Outstanding mortgage, I don't know, 208 grand. Mortgage origination date. Again, this gets a little boring when we're just typing in all these numbers. This will be my last entry here if we don't start getting going. Mortgage insurance premiums. There's a thing called if you're unable to make the down payment that's sufficiently high, um, you may have to pay a premium on that until you say they wanted 20% down, but you only had 10% down. The lender may actually require additional insurance to be paid, which is, typically I had to pay it one time. It was about 125 a month. So it was kind of a drag, but as soon as the house appreciated by just a little bit, I could claim that equity against that 20% that they were looking for, and then all of a sudden I was good. So I already put the 4,000 in there. I did not have to pay any mortgage insurance, and we'll just continue on from there. So now you see the numbers change dynamically. So if you were renting a house or you were buying a house, now granted there's a lot more, there's upkeep and things like that you might have to do if you own the house, but there's other things too. You own the thing is hopefully appreciating, so you're enjoying that part. But just strictly from a dollars sense, we went from owing 253 to getting 1,756 back. So you can see that if those two amounts, the rent and the mortgage payment, were the same, in this case, you're actually 2,000 ahead by paying that mortgage, because the interest portion and the taxes portion, you were able to write that off on your taxes. So I think on those charity numbers, we probably just had not hit the threshold. We were hitting the standard deduction, and that's probably why the numbers weren't jumping on us there. Let's just confirm that real quick. Well, it turns out, what did I do? I just was blindly hitting. I got to go back. Sometimes there's some of these caveats that you got to pay attention to. Is this loan? Is this loan? If your loan is secure, there's a 1098 in the address box 7. Yes, the property. Is it a home equity line of credit or a loan you've? Nope. Yeah. Anyway, that nasty note went away because you would have seen this 1756 roll back up to the 253. So again, that's why, the program is nice that you just go, wait a minute, what did I do? And then you fix it. So let me check this number. We donated 5,000 to charity. We're going to edit that real quick. We're getting more generous. Same junk, but now we're saying it's worth $6,000. Yep. So that was it. So in my buffoonery there, I kind of illustrated what I was talking about with the standard deduction. We had not hit the standard deduction. It was already adjusting the numbers based upon the standard deduction. We hadn't hit that threshold. Because of all that mortgage interest we paid and all that property tax we paid, we exceeded that threshold. So now we're getting credit for these things that we're doing. Job expenses on the W-2, medical expenses, again, those had to hit 10%. Lots of other cool stuff, other tax breaks. Sales tax gets a little confusing here in Alaska, but you get credit for that. You get money back from that. And because we've hit the standard deduction, it does make sense. Different means of entering that in. Anyway, I don't want to drag this out all night, but I think you've learned a little bit, and we'll call it good there. We'll reattack um, tax issues on subsequent lessons, but I think you've got the gist of the overview. Good night.